Yo, what's up guys? It's your boy Looney. Today we're sizing up August and September, what they can mean for the markets. I'm somewhere in between, but I'm also skeptical. Companies are missing earnings, macro fears are rising, and stagflation risks are real. Before we get into this video, quick shout out to the Discord. It is free to join. And then I also offer a premium membership that's $8 a month. And that gives you access to one-on-one coaching, trade callouts. I have an option selling course. I do giveaways and more. You can check it out. All the links to that are in the description. Let's jump in. We're going to first take a look at macro and the market landscape. And then we'll get into what my strategy is for these upcoming months. Number one is stagflation risk is rising. Top economists are warning the US could face stagflation, which is slowing growth, and there's still sticky inflation and higher unemployment, which is very true. We are seeing that with the most recent reports with the FOMC. Something else is there is Fed rate. Fed rate cuts are priced in. They are betting that there will be Fed rate cuts upcoming. So let's actually look at that. You can look at it on Robinhood. You could actually see it in its prediction markets, but you could also look it up on any kind of website or just do your research and you could sort of see where it falls. What are the chances of a Fed rate cut? So you can see here, Fed rate decision, whether they decide to cut it, maintain it, or cut it less than that, whatever, or more than that. But right now, it's pricing in an 80% chance of it actually happening, somewhere around there. Different websites or different resources have a different probability, but right here you can see it is rated at around 80%. And just some historical context, on average, the S&P 500 has gained over 30% during Fed easing cycles, but during recession periods, markets didn't respond well to cuts. And I don't believe we're in a recession, but I also don't believe that we will see these massive 30% jumps. I'm somewhere in between. Lastly is retail-led bounces amid uncertainty. So even after weeks of job data, markets are rallying, which is driven largely by retail investors aggressively buying the dip. We can look at several examples. We have Palantir and Hood. Hood I own. We can see everyone is just simply buying the dip. Past 3 months up 121%. So could this rally keep going? Possibly. But there is a chance that this finally cools off. And that's what I want to get into, my strategy and what I'm doing, because I am a little bit cautious of a backdrop. I am hoping for easing, but I'm skeptical of any sort of impact. So this is what I'm doing while I'm waiting things out. Number one is I am selling puts. I'm selling options, and I do this all the time, no matter what kind of market environment we are in. I'll do more depending on where we're at, and I'll do less depending on where we're at. So right now, I'm somewhere in the middle of selling options. I'm just doing my average, or seeing opportunities, I am selling puts. If we see more dips, I will do more puts at lower strike prices, but that's what I'm doing. So a few names that I'm doing it on is Oscar. This one reported earnings, and it was getting a lot of bad publicity. So I kind of had the feeling that all this bad news was already priced in, and that's why I sold a couple cash secured puts. I sold 4. I had actually a 5th one that I did close out, and you can see these are doing pretty well. I got assigned on another one at that $15 range. It brought in my premium, so it says 14.15 as my average cost. But yes, I'm also doing cash secured puts here. And you can see I'm averaging down. So I did one at $12, and when it continued to go down, I did 11, and right now I have 11.5, so somewhere in between. So you can see how powerful selling puts are. I'm collecting premium on all these. And on the other hand, I'm also collecting income on selling covered calls. So I waited for earnings to come out to see where the stock was heading, and then I sort of reacted to it. So I sold a covered call at that $18, and you can see here collecting $30 or $33. So I tried to wait for the stock to actually go up to sell a covered call. I chose a strike price that I believe is pretty high. It is possible that Oscar goes past 18, but you can see here pretty unlikely. I chose a low delta of 0.2. Still a chance, but a lot of cushion with that one. Number two is just I'm simply holding cash. Staying liquid actually gives you flexibility if things get choppy or there's just better bargains that emerge. And some people might be thinking if you're predicting a downturn, just buy puts or short it. But you could also actually hedge the market by just holding cash and just waiting for that opportunity. Something like SoFi is one of those examples. SoFi is a great stock. I could see the stock growing, but as of now, in the short term, there is a chance of volatility. I wouldn't say now is the best time to invest into it, but now is not the worst. So if you're just starting, maybe sell a cash secured put at a lower strike price. But I'm not actively investing into it because I did all the investing back in April, and I'm just simply holding cash. If SoFi goes down to $15, then yes, I will deploy that cash. And similarly with my other stocks like Riot or Mara. This one, I was holding cash and now it finally has dipped and my total return is negative. So to get my average cost down, I'm selling more cash secured puts and again, covered calls. So I'm earning premium on both directions. So holding cash is actually a really powerful tool. Right now, I have about 12%, somewhere around there, 10 to 12% in cash. And a lot of people use the VIX or the volatility index to decide where they're at with cash. Anywhere under 15, things are pretty safe and stable. And that's kind of when you want to have some cash. You want to have cash availability for any kind of spike in volatility. When there is spike in volatility, this is one of the best times to actually invest or get started into any sort of risk-on investment. Number three is I'm dollar cost averaging. So I mentioned I'm deploying cash. I have cash, but I'm also deploying it very slowly. I'm doing it into crypto is my main one with DCA and some other big names like Hood, Robinhood. I'm putting a little bit a day. And if we do see a crash or even more volatility or downward direction, I will start to deploy more cash. So Robinhood, I'm putting $2 a day. And if the market or some kind of tariff news comes out and the stock goes down to 60, I'll probably do a lot more. I'll probably do around $5 or $6 or even buy shares. So that is my strategy moving forward. I am cautious, but I'm also prepared for the upside. I'm prepared for both directions. I have the cash for the downside. I have the selling puts for sort of like a neutral market, and I'm dollar cost averaging for that bullish momentum. So looking ahead, August may stay a bit choppy. Historically, lower volume and heightened volatility happens in August. There's also tariff headlines and earnings are missing, so that may fuel swings. If we look at something like Snapchat, which I wouldn't touch right now, I was thinking about selling a put, but I held off, and this is one that was down 20%. SMCI, another one. These ones were sort of being exposed for what they truly are or what their values are, their fair value. They're being exposed. Even Hims was hit pretty hard this past earnings report, down 14%. Massive swings. Hims is a very volatile stock. I have a few shares, but overall, there is a lot of companies missing earnings because of all the macro news. September could be the wild card. If the Fed cuts, markets could rally, but only if it's supported by fundamentals. And if stagflation worsens, we may see renewed selling. I'm not entirely sold on the idea that Fed rate cuts will push the market because this might already been priced in. A lot of people already expect that September is going to see cuts. So I'm very curious to see how September actually responds to this. It might be a little delayed reaction. It might be instant. That's why I'm not going all in, but I don't want to be caught on the sidelines. So that's my bottom line. I'm playing it safe, collecting that cash, staying in cash, and just DCAing where I see long-term value. Let me know in the comments what you think. Are you bullish? Are you bearish? Or just watching? Peace out. Until next time.